Hey guys, Stock Saturday, and it's been a pretty good week for me. This week I'm about 5.5% up, about 22,000, which compared to the markets, Nasdaq is down 1.42%, and the S&P is down 1.06%. So, yeah, done reasonably well. This is sort of largely off the back of crypto having a reasonably good week, which sort of come back to in the portfolio. But some stuff in here has been sort of doing okay as well. TSMC sort of pushing to what I think is pretty much all-time highs. Broadcom sort of hanging around that area. But I have been making some additions. You notice cash amount is sort of down a reasonable amount. I spent about 8 grand, basically adding to sort of the new holdings pretty much. Bought a little bit more Euronext, a bit more Adecco Agro, FMC, CME, CF Industries, Ingredient, BlackRock, and I left Applied Materials. It went up about $5 sort of in about a couple of hours as I was sort of looking to buy, and I sort of thought I've already got 5,500 in it. Would like to increase it at some point, but yeah, I held off. So still more cash to put in, but yeah, we'll see where that goes. So while we're in this sort of quiet period without any earnings to speak of, I thought I would have a quick pass over sort of Yahoo on the new holdings. So sort of having a look through what initially got me interested and sort of what I like about some of them financially. So BlackRock, you can see obviously we all know BlackRock. I hadn't sort of really considered exactly how they make all of their money. Obviously, everyone talks about them having 10, 11 trillion in assets under management, and they sort of charge a small fee on that. A lot of the ETFs are you know 0.07% on things like the S&P, maybe a bit more for all world funds and things. And yeah, they sort of that is then their revenue, that percentage on that assets under management. But I hadn't really considered that it would be quite that profitable a business. So you sort of look here, 4.9 billion, 5.9 billion on like 19 billion of revenue. Sort of it tends to just drift up and down with revenue, sort of culminating in trailing 12 months 6 billion on 19.3 billion in revenue. So yeah, you come to the stats page, and yeah, so for trailing 12 months, you're looking at 31.3% net profit. So yeah, I guess it is just a load of sort of asset managers, a lot of passive stuff, so a lot of it can be done by algorithms, and yeah, it is quite a profitable business. So 31% is, I would always call 30%, the best of the big tech margins. So yeah, 30% net margin, and yeah, just looking at the sort of stats page, yeah, looking at sort of forward PE of 21, which is sort of lower than quite a few of the big techs. It's always worth checking out sort of, whether there's anomalies here. You can check like net profit against market cap. You can check the sort of analysts' estimates of next year, just to double check that they align with forward PE here, and just sort of see if there's any anomalies. Check free cash flow against market cap, and yeah, just sort of see if everything lines up basically. And it seemed to with BlackRock. It's not that sort of profit isn't an anomaly. Certainly, they just do quite well. So yeah, that was sort of what kind of got me into them. Reasonable balance sheet as well, sort of net cash, and yeah, what we got 9.7 billion in total debt, and yeah, 10.6 billion in cash. Always a bit wary with sort of financial companies, whether all of this is theirs. It's a little bit different to sort of some of my food stocks or semiconductors or whatever. Cash is cash, and debt is debt. But yeah, with some of these sort of financial companies, I did want to just have a bit more of a dig through, and it all appears to be legit. So yeah, that was BlackRock, I would say. The CME Group, I think I found through a stock screener where I was sort of getting very much addicted to profit margin, and yeah, sort of found them 83 billion market cap, and yeah, had no idea that derivatives and sort of the FX market and futures would be quite this profitable. So looking at BlackRock being sort of 31%, you've got CME, 2.1 billion of net profit on 4.8 billion of revenue, and it's sort of that margin has risen over the last few years, sort of 3.1 billion in 2023 on 5.5 billion of revenue, and then 3.4 on 6 billion of revenue. So yeah, looking at on their stats page, you're looking at 57% net profit. It looks like sort of fairly consistent quarter on quarter. You sort of gets up to 60% sometimes, between 55 and 60%, which is sort of pretty much the highest net profit that I've seen. I always look at sort of Visa as being one of the top in the world, and yeah, had sort of no idea that derivatives would be sort of quite that profitable. And again, you can check sort of on the balance sheet, but enterprise value sort of slightly more than market cap, so they haven't got a huge amount of debt, and sort of reasonable valuation. Forward PE of 22 all seems to line up. So yeah, for a sort of fairly large, business. So yeah, for a sort of fairly large business with a hell of a large moat, I would say, largest sort of derivatives exchange in the world. I don't sort of see anybody else really getting into it. I thought, forward PE of 22. They're not growing sort of super fast, obviously. So, something like PEG ratio of 8 isn't, I wouldn't call them a growth stock as such, but it's just that heavy profit. So that gets you, a reasonable dividend yield, and they do buybacks, and they are growing, of course, and that does sort of reflect in the all-time stock price. You might get, last 5 years it's been a little bit quiet, but obviously over time it does go up, and yeah, sort of thought this was a great little business at sort of a reasonable valuation. You sort of, again, like 24 PE, 60% profit. No one makes 60% profit, but the other, businesses around sort of 24 PE, certainly in like the big tech sector, you're sort of thinking, Apple quite a bit more than that. You've got Google and people like them. I mean, Google are at 30% profit. Apple sort of more like 15. If you're selling physical products, it's very difficult to make too much more than that. They might make 20, but they're never going to make 60%. So yeah, I thought a company with what appears to be a fairly solid moat and incredible margin that doesn't seem to be able to be eaten away at in any way, I really liked. And then similar thoughts here with Euronext. Actually sort of found this from the Playing Footsie boys, Steve D, if you know, in the Discord as well. Yeah, he sort of mentioned Euronext last year, and sort of a couple of months ago, just recently as well, in their sort of European focused pie, and sort of made me just take another look at them, and another one that wouldn't have expected them to be making anywhere near this much profit. Just a stock exchange, and sort of derivatives exchange, debt exchange as well, and sort of, yeah, they just take a fee for listing companies. They take a fee for arranging bonds. We sort of looked at them before. Act as middleman for various transactions, debt transactions, and FX, and all sorts. And yeah, that is a incredibly sort of profitable business as well. Much smaller company than what we've been looking at CME and BlackRock, but 315 million net profit on 884 million, sort of back in 2020, growing to 513 million on 1.4 billion of revenue. So yeah, you can see what we're looking at, sort of similar to BlackRock, really, about 36% net profit, very high, slightly higher than BlackRock. Nowhere near sort of CME group levels, but very nice. So other stats look pretty solid, and that profit was consistent. It's not a one-off, certainly. This is another one of those strange sort of companies on enterprise value. The debt, I think, isn't, it doesn't show up here sort of properly, but yeah, the other metrics look fine. Forward PE of sort of 16 for, basically an impenetrable moat, I would say. I don't sort of see other stock exchanges really coming in. They've got the Deutsche Börse in Europe, which is sort of a competitor, but yeah, unless you get Intercontinental Exchange, who own the New York Stock Exchange, sort of coming in, can't really see that. It's basically sort of an impenetrable moat, high profit margin and fairly low valuation. Looking at the debt, I can't remember what was going on there before. I did have a look. So yeah, sort of 3.1 billion in total debt, and yeah, so they show cash as they've got other short-term investments. That's what's sort of skewing the numbers there. But 1.4 billion in what looks like their own cash, and 3.1 billion in debt. So it gives you a net debt of 1.6. These quite easily serviceable in Europe. They always love their low rates, and rates are already coming down again. So you can come down here and see interest expense. A lot of these companies are sort of doing the same really at the moment. They used to be having a very small amount of income and similar, or sort of a much higher interest expense. Now with the high rates, that debt is still on long-term rates, so interest expense is the same as a few years ago, but interest income on sort of similar amounts of cash is like 4 or 5 times. So yeah, for now, extremely serviceable debt, and doesn't do anything to eat into this net income or sort of operating income. So moving away from financials onto the semiconductor new stock that I bought. Obviously, I've still got quite a few other semiconductors, but I wanted to add another company, and I got Applied Materials. So 138 billion market cap, reasonably big. And obviously they are selling physical products where the others are not, but are still able to command sort of a reasonable margin. Sort of 5.8 billion in profit on 23 billion in revenue, coming up to 7.1 billion on 27. So that's pretty nice for as I say, selling physical products. 27.7% net profit is you're going to struggle to beat that, really. So they're sort of commanding what appears to be a reasonably large moat. There's sort of 2 or 3 other companies, smaller companies, always chipping away at their heels, but yeah, they're sort of a mainstay in the industry, basically, alongside ASML and TSMC and people like that. So yeah, nice 27% margin. And they've been having sort of a little bit of trouble, slowdown in, I wouldn't say trouble, but a slowdown in revenue. You sort of got the memory industry not doing particularly well. AI obviously is smashing it, and they're buying everything they can get. But memory companies spend a lot of money on gear, and they're not at the moment. So yeah, you've had sort of revenue come to a little bit of a slowdown, 26.5 billion. In 2023, and only sort of 27.1 last 12 months. So yeah, it's not a huge amount of revenue gain there, but you can come in sort of see 2025 they're looking at 29.3 billion, and they're expecting 31.7 next year. So looking hopefully back to growth. You can see the EPS trend from what is 30 analysts, 25 for next year. You can sort of see I quite like looking at this trend, so you can sort of see the average of what all the analysts had as earnings per share like 90 days ago, and 60, 30, and down to the current estimates. Those have been coming down a little as things don't look quite as rosy. Next year, sort of looking at $10.54. I think this is fiscal year. That's not to actually 2026. So $10.54 gives you that sort of solid forward PE, about 17, 17 to 18. It's been coming down a little bit as prices dropped, and sort of earnings still expected to go up. So yeah, for again 27% net margin business for this sort of valuation, I thought was solid, and sort of still a growing company. Sort of not unlike the others. The Applied Materials are sort of growing quite a bit more, so you get this sort of lower PEG ratio, closer to 1. Everyone sort of with growth stocks wants under 1 ideally, but sort of between 1 and 2 is still pretty nice as well. So moving on to my sort of newest little food pie, we come away from high profit margin certainly, but it's an area that I think is still essential and we will need going forward. I sort of mentioned before that I was wanting to get into some more food stocks, but not really interested in the sort of staples that people generally go for, your sort of McDonald's, Pepsi, Coke, and people like that. Mondelez even, I've looked at Mondelez because they just all seemed like junk food that you could sort of essentially do without if times got hard. And you've got Robert F. Kennedy Jr. sort of coming in, I think, wanting to crack down on sort of junk food and additives and that sort of thing. Which, admittedly, I do have ingredient, which I'll come to, but sort of people like FMC, maybe he wants to sort of clamp down on fertilizers and sort of artificial products going into food, but I can't really see it. He's going to want more, people eating sort of fruit and veg and basic foods, so I can't see you get away from farming sort of based companies, but that was sort of part of the reason for wanting them, something a bit more defensive, and obviously you get with that comes a lower valuation. So you're looking at sort of 551 million on 4.6 billion of revenue, sort of coming up to operating income, I suppose, 594 million, because they've had a fairly big tax refund from some write-downs and bits and pieces. So sort of 10 to 15% margin it looks like for the most part. It's not 35% this year, but sort of 10, 15% operating margin, 10% net margin for the most part. I thought was reasonably good, and sort of gives you, trailing PEs are extremely well. Saw a couple of people, referencing like a 4 PE being extremely low valued, but that 4 PE comes from the tax adjustment that you just saw. So that should really be done on sort of operating income, less what tax normally would be, if you like, and then sort of, or done on cash flow basis, that should really flag as an anomaly, especially with like forward PE being just over 10. But 10 for a reasonably sort of big business like this with sort of still decent profit, I thought was quite good. Balance sheets sort of okay. They do have a reasonable amount of debt. We got 4.1 billion in debt, but it seems very serviceable. Cash of sort of 300 million. Would prefer that to be quite a bit more, but obviously we're looking at sort of fairly cheap valuation companies, and as you can sort of see, that reduction in profit over the last sort of, profit margin, I suppose, without that tax adjustment, has meant people are a little bit unhappier with them. Used to be at sort of 120, and we come down to $48. So yeah, I'm still sort of looking into them, looking more at fundamentals, but I decided to sort of take Stanley Druckenmiller's idea of see it, buy it, and start looking into them more as you go. So Ingredient, as I looked at before, potentially one of companies that someone like RFK might be looking to crack down on, being sort of essentially all additives and I guess he would call nasties. They would say they're making sort of healthy food a little bit easier and more flexible and all sorts. The and they call it, sort of, if you want fruits, food to be nutritious and long life, or and something else. That is what they provide. But yeah, sort of financial wise, they are quite low margin. You sort of look 348 million on 6 billion of revenue, sort of coming up to 683 on 7.5. So we're under 10% on net margin, sort of 9%, 14% operating margin. That does give you a sort of a cheap valuation, of course, with being low margin, not particularly high growth. Forward PE of 12. I thought that was fairly solid. Has been that sort of for a reasonable amount of time, sort of in the 10 to 11 range in 2023. So yeah, not a huge amount changes, but I thought they looked pretty solid. Another company with a fair amount of debt, 2.4 billion and sort of 400 million of cash. Not a huge amount. Less debt than FMC, and a larger market cap company. So balance sheet, I would say, is a little better, and their sort of cash to debt ratio is a little better. Sort of reasonably easy to service that debt. Look at sort of interest expense, 50 to 100 million. They're making sort of 900 in operating income. So yeah, fairly easy, and quite a nice company, I thought. And then CF Industries, larger than FMC and Ingredient, sort of 15.4 billion. Another fairly sort of low margin company, 317 on 4.1 billion, coming up a little bit more to 1.1 billion on 6 billion of revenue. So yeah, it does give you sort of, certainly for the last year, they've had a reasonably good year, 20% net profit, and yeah, sort of other metrics look good as I was looking through. This isn't sort of some strange anomaly from the looks of it. Operating income looking really solid. Fair bit of debt, as they all seem to, but well, a little bit more than in Ingredient, but a little bit less than FMC, and they're sort of over double the size of FMC. Should look on the quarterly for something like debt as well, just to see if anything's changing. And sort of net debt has been slightly increasing. Shares sort of coming down a hell of a lot. They're doing an awful lot of buybacks. 191 million shares down to 174 in just a year. So they're clearly doing an awful lot of buybacks, and yeah, that's what they're doing with their cash, paying a reasonably nice dividend as well, 2.26, and it's growing. So yeah, I thought a reasonably nice company. Just looking at the valuation, it's forward PE of 13, sort of trailing 14. That's up sort of slightly from previous quarters, and yeah, PEG ratios sort of all over the place because they're a very cyclical business. So sometimes you get not applicable because they're shrinking, and yeah, they're not not a growth stock. It's not that sort of company, but goes quite well in this pie. And then rounding off my pie, the sort of small cap that I went for, Adecco Agro, sort of more of a strictly pretty much farming business. They do a bit of dairy as well, we sort of looked at, and very much a small cap, 960 million, sort of primarily focused on South America. So a lot of these companies are fairly cheap over there. But with that sort of comes a very, very healthy valuation and sort of reasonably high profit. They're sort of a little bit all over the place. Cyclical business. You had 226 million net profit in 2023, coming down to sort of 157 trailing 12 months, and it's sort of again all over the place. 82, 9, 18 million. But yeah, looking at sort of the future, there isn't a lot of analysts sort of predicting things. They've got one for this year, two for next year, but $1.89 earnings for next year for a sort of, what is it, after hours, $9.36 price. I think if they come anywhere near this, then that would be pretty solid. Sort of balance sheet wise, didn't think they were looking too bad. They got a little bit of debt, 1.2 billion, so it's more debt than the market cap, but reasonable amount of cash, 339 million, and they seem to be able to sort of service that debt relatively easily. You got interest expense of 60 million, so yeah, it is quite a portion of operating income, but yeah, that sort of goes without saying for some of these farming type companies, but I thought they looked pretty solid. And then my newest acquisition, Evolution. So I kind of look at the Swedish Stockholm listing here, because this is sort of where the analysts are, but I did end up buying the over-the-counter one. We're not allowed to buy the Swedish one here. So yeah, 180 billion. That's not, I would normally be looking at dollars or pounds, but that's 180 billion Swedish krona. So you divide that by sort of 12, I think it is near enough. But yeah, this is where this come off the Discord. Sort of few people had mentioned it a few times, and I'd never really sort of knew they were in the gambling industry, but where I was sort of having my addiction to profit margin, suddenly saw these and thought, Jesus Christ, that's a lot of profit. And sort of a aggressively growing business, I would say, sort of 561 million revenue to 2 billion in the last 4 years. So yeah, 4x revenue and 289 million net profit, up to over a billion, 1.15 billion profit. So fast becoming sort of the small little club of over 50% profit margin, which, with CME and Visa, and I'm not really sure I can find sort of too many others. You got Rightmove in the UK, and yeah, sort of there'll be companies that do that in a year, but to sort of be consistently doing it every year seems incredible, really. 65% operating margin, and incredibly a very, very cheap valuation, because sort of things maybe haven't been going quite so well. They've got some legal issues in the UK and sort of other, allegations and things towards them, but it seems to be a fairly small part of their business. So sort of trailing PE now of 14, 12 on a forward basis. They've got sort of reasonable amount of analysts covering them on the Swedish listing. Sort of expecting 2.37 billion revenue for this current year, I guess, up from 2 billion in 2024, and yeah, earnings sort of relatively stable, been coming down a little bit in the last 90 days, but yeah, sort of six. I think this is euros, so the it doesn't really relate to the stock price there. A lot of the numbers sort of in here are in euros, and then market cap and price is Swedish krona. So yeah, you have to do some adjustments sometimes, or sort of just look at their quarterly reports rather than here. But yeah, if you sort of look at on a relative basis, it's fine to sort of use these numbers just to see trends and things. So yeah, incredible business, sort of high margin, and who knew sort of live games of bingo and sort of roulette wheels and things, and blackjack online was quite that profitable. You're looking at, again, tiny amount of debt, 82 82 million. Guessing this is 82 million euros compared to 663 million in cash. Some of that is, yeah, they don't show it here, but sort of looking at their quarterly report does all look legit. I mean, if you're making 55% net profit, it's no surprise that you don't really need a lot of debt, and if you do get any, you can sort of pay it off relatively quickly. So that just all comes out to a reasonable dividend, 3.5% on the dividend, and I can't remember whether they were doing a lot of buybacks. Just looking at the balance sheet, yeah, they're not really super keen on buybacks. They're keen on growing. So yeah, hence the revenue. They sort of make a lot of acquisitions and sort of opening up a lot of new sites and things. And yeah, if they can do that profitably, I'd rather they do that than pay a dividend or do buybacks. So yeah, strange one. I didn't add to it this week. They're up about 8% already since I bought, and sort of just didn't want to chase that up immediately. I'm still kind of looking into them, but yeah, look a solid company. Economic news didn't have a huge amount this week. Obviously, we had New Year's Day and New Year's Eve. They were sort of closing early. Sort of had some house price news from the UK. Still very, very high house prices, unbelievably. They always seem to defy expectations. Jobless claims and things from the US looked pretty good. Nothing sort of too much happening there. The GDP numbers sort of on the Atlanta GDP Now thing coming in quite poor, 2.6%. Where they were getting 3.1, fairly consistent 3%. Was expected to stay at 3.1%, and it came down to 2.6. And then on Friday they do it 2 days in a row. It come down to 2.4. In one day. I haven't really looked into sort of exactly how that works, but it does seem a bit crazy. Thursday to Friday, you've dropped 0.2% in GDP for Q4. Obviously, Q4 is 3 days old now, so it's still provisional figures, but yeah, interesting. And then portfolio-wise, as I say, the crypto miners sort of did a fair bit of work to help the portfolio this week. Certainly, just yesterday, Riot Platforms up nearly 18%, CleanSpark up 14%, sort of being the largest position. That does wonders. Gold and silver sort of having a slightly worse week, but still hanging around sort of similar prices. Equinox was below below $5 sort of for a brief period, so back up to 5.19. That's not doing too bad. And then Hive, my smaller position, up 7%, and the others sort of not really moving too much. You had KGHM sort of not really going anywhere, sort of similar with Pan American. And yeah, on the option side, I bought a little bit more Hive blockchain or Hive digital, and those were actually sort of took some little short-term bets on a sort of them getting to a $7 price rather than sort of $10, which most of mine are, but by June rather than by sort of January next year, January 2026. I kind of thought if we are going to have a bull run, it probably will be a fair bit of the way there by June. So yeah, they seemed quite a good price, and yeah, thought I'd have a little punt. Riot sort of doing particularly well. Hive, Riot, and Hive and Riot both doing well in here, and obviously these main stocks in the ISA. Max sort of down a few thousand. Equinox did buy a reasonable amount more of Equinox. Looking quite good. Kerr Mining sort of up a little bit as well. And I did notice Bob Lucas, the sort of one of the Twitter people that I follow, is sort of back for the new year and put out a load of stuff sort of quite bullish on stocks, gold, and crypto. But yeah, if sort of some of those predictions come even close to being true, then I think all of this pretty much should be doing incredibly well sort of to mid to late this year. So yeah, still a reasonable amount of cash. Spent about 1,000 this week, and hoping to deploy more of that in the near future. So interesting. Leave your thoughts then in the comments below. Hope everyone's having a happy new year, and like and subscribe. See you soon.